Hey, hi all, welcome back. Today, I want to talk about something that affects literally every single person watching this. Whether you are a nurse, a teacher, a tradie, a business owner, an employee, a student, or a retiree. And that's your money. Specifically, the money which is in your bank account, your savings, your super, your investments, and why the system that's been underpinning all of that for the last 80 years is quietly but very visibly starting to crack. Now, I'm not here to scare any one of us. I'm not going to put up a flashing red alerts and going to tell that everything is going to end tomorrow. It's not about that. But I am going to give you the clearest, most honest picture I can of what is actually happening in the global financial system right now and what ordinary people like us can do about it. Think of this as a conversation your financial advisor probably isn't having with you. And by end of this video, you're going to understand how the US dollar became the world's reserve currency, why that position is now being challenged for the first time in a generations, and what the new financial system being built looks like, and 6 practical, sensible steps you can take to protect ours financial future. No jargon, no Wall Street speak, just the plain truth. Now, to understand why the dollar is weakening, we first need to understand why it became so powerful in the first place. Because this wasn't an accident, it was a very deliberate design.
Cast your mind back to 1944. World War II is almost over. Europe is in ruins. And 44 nations sit down in a tiny mountain town in a New Hampshire called Bretton Woods to decide how is global trade going to work after the war. The decision they made was simple but enormous. Every country's currency would be pegged to the US dollar, and the US dollar would be backed by gold at a fixed rate of $35 per ounce. The US, being the only major economy left standing after the war, became the financial anchor of the entire world. That was step 1. Step 2 came in 1974, and this one is arguably even more important. Following the 1973 oil crisis, President Nixon's administration struck a secret deal with Saudi Arabia. The deal was this: Saudi Arabia and OPEC would price all oil, the world's most important commodity, exclusively in US dollars. In return, the US would provide Saudi Arabia with military protection and weapons. This created something called the Petrodollar system, and it was genius from America's perspective. Here is why it was so powerful. Think about it. Every country on earth needs oil to run. Factories need oil, cars need oil, ships need oil, planes need oil. So if all oil can only be bought in US dollars, suddenly every country on earth needs to hold US dollars all the time just to keep their economies running. Imagine that single deal created a permanent global built-in demand for the dollar. Overnight, everyone in the world needed dollars, not because they particularly liked America, but because they needed energy. And that's the most important insight in this whole video. The dollar's power was never really about America being loved. It was about structural dependency. Nations didn't choose the dollar because they wanted to. They used it because everyone else used it. That self-reinforcing cycle is called a network effect. And for 50 years, it made the dollar virtually unbeatable. But that network effect is now getting dismantled, being dwindled.
Okay, so here's where we get into what's actually happening right now. And there are 4 major forces all working at the same time to erode the dollar's power. Not one of those alone would be enough, but all 4 together.
Let's start with the most straightforward one, the US national debt. As of March 2026, the US government owes $39 trillion. That means 39 and many zeros. Now big numbers are hard to wrap your head around. So let me give you some context that really brings it home. The US added $10 trillion in debt in just 4 years between 2020 and 2024. That's more debt than the United States accumulated in its entire first 200 years of existence combined. And here's where it really gets alarming. In 2025, the US spent more money just on the interest payments on its debt. That's $1.1 trillion. Then it spent on its entire military. The military that's supposed to be the most powerful on earth. Debt interest is now the single fastest growing item in the US budget. All three major credit rating agencies, Standard & Poor's, Fitch, and Moody's, have now downgraded US debt. Yes, downgraded US debt. That's the financial world's equivalent of your bank losing faith in your ability to repay your mortgage. And here's the doom loop that economists worry about. More debt leads to more interest payments. More interest payments means the US has to borrow more money to pay the interest. More borrowing means more dollars get printed. More dollars in circulation means inflation. Inflation means each dollar buys less, which weakens the dollar further. That cycle is already underway.
The second force is what's called de-dollarization. That's a fancy word for countries actively choosing to move away from the dollar in their trade and reserves. In 2001, the dollar made up 72% of all global foreign exchange reserve. That means 72 cents of every dollar held by central banks around the world was a US dollar. And today, it's 56.9%. That's the lowest it's been since 1995. Now you might think, okay, it's still more than half, so it's still dominant. And you're right for now. But the direction of travel is unmistakable and the pace is accelerating. Global central banks, the reserve banks of China, Russia, India, Saudi Arabia, and dozens of others bought more than 1,100 tons of gold in 2025 alone. That was the largest annual gold purchase in 70 years. They are literally replacing the dollar reserves with the gold. Meanwhile, China and Russia now conduct almost all their trade with each other in yuan and rubles, completely bypassing the US controlled payment system. Saudi Arabia began accepting Chinese yuan for oil in 2023. And the BRICS group of nations, that's Brazil, Russia, India, China, and South Africa, now expanded to include Saudi Arabia, UAE, Egypt, Iran, and others, collectively represents 28% of global GDP and 44% of global oil production. They are building an entire parallel financial architecture specifically designed to operate without the dollar.
Now, this one is crucial and it's often overlooked, so listen carefully. In 2022, when Russia invaded Ukraine, the US and its Western allies did something that had never been done before at this scale. They froze $300 billion worth of Russian sovereign reserves money that Russia had held in Western financial institutions. They also disconnected Russia from the SWIFT payment network. Now you might think, well, that makes sense as a sanction against an aggressor. And maybe it does. But here's the unintended consequence that nobody talks about enough. Every other country in the world, China, India, Saudi, Brazil, Turkey, watched that happen and thought, if Russia's reserves can be frozen like that, so can ours. If we hold our savings in dollars and something goes wrong with our relationship with Washington, we could lose it all overnight. JP Morgan's global macro research team put it plainly in 2024. They said the weaponization of the dollar had become the single most powerful catalyst of the de-dollarization, more powerful than anything BRICS could have planned in a meeting room. By using the dollar as a weapon, America essentially told the world, your money isn't safe here if we disagree with your politics. And the world responded by quietly, systematically starting to move their money elsewhere.
In 1960, the United States produced about 40% of everything the entire world made. Today, that number is around 25%. That's still enormous, don't get me wrong, but it's a significant decline. And yet, the dollar still represents nearly 57% of the global reserves. That gap between America's actual economic weight and the dollar's reserve status is, in the long run, unsustainable. Reserve currency status historically follows economic reality, and economic reality is shifting. Here's another telling data point. Foreign central banks used to own more than 50% of all US government bonds, treasuries. By early 2025, that number had fallen to just 30%. The world's appetite for holding American debt is falling. That means the US has to pay a higher interest rate to attract the buyers, which makes the debt problem worse.
Now I want to spend a moment on what I think is the most significant single event in global finance in the last decade, and one that got almost no mainstream media coverage. On June 9, 2024, Saudi Arabia's 50-year petrodollar agreement with the United States expired, and it was not renewed. Let that sink in for a moment. The deal that created the petrodollar system, the deal that since 1974 had made global oil trade dollar only, that deal has gone. Saudi Arabia is now free to sell its oil to anyone, in any currency, on any terms it chooses. And remember, who Saudi Arabia's biggest customer is today? Not the United States, China. China now buys more than 20% of all Saudi oil exports, and China is now paying for some of that oil in yuan. So what does this mean for you practically? A few things. Firstly, there are now fewer countries that need to hold dollars specifically to buy oil. That reduces global dollar demand. Second, oil exporters are no longer required to recycle their surplus dollars into US Treasury bonds. They are diversifying. So the US government has to pay more to borrow money, which means higher interest rates across the entire economy, higher mortgage rates, higher car loan rates, higher credit card rates. Third, if fewer dollars are needed globally, the dollar's value can gradually weaken, and a weaker dollar means everything imported into the US becomes more expensive, which means inflation. And none of this happens overnight. The petrodollar didn't die on June 9, 2024. Network effects are powerful, but the structural incentive to hold dollars specifically for oil, that's gone now. And that matters enormously over the next decade. Okay, I want to spend a few minutes on the data. Because sometimes seeing the numbers laid out visually makes the trend undeniable.
The reserve currency chart. From 72% in 2001, the dollar share of global reserves has declined steadily to 56.9% in late 2025. That's about 1% point lost every 18 months. And at that pace, the dollar falls below 50% of our global reserves is by around 2030. The debt clock from $5.7 trillion in 2000 to $10 trillion in 2008 to $27 trillion in 2020 to $39 trillion today. The trajectory is not linear, it's accelerating. The Congressional Budget Office projects this could reach $50 trillion by 2030. Gold buying, as you can see, central banks bought just 450 tons of gold in 2021. That number jumped to over 1,000 tons in 2022, 1,037 tons in 23, 1,045 in 2024, and 1,100 tons in 2025, the single biggest gold buying spree in 70 years. They are literally converting dollars into gold. Treasury foreign ownership, as you can see, foreign central banks held 53% of US treasuries at peak in 2008. Today, the figure is 30%. The world's appetite for American debt is clearly falling. two lines going in opposite directions at the same time. Gold buying surging up, dollar reserve holding falling down. That tells you everything you need to know about where global confidence is shifting.
Now we should be able to appreciate the current war of Iran versus US and Israel, which everyone is covering as a nuclear standoff. That's the surface layer. This war is about who controls the price of oil in whose currency and who gets to sanctions whom for stepping out of line. Since 1974, as we have learned, one deal via the entire global economy, Kissinger and Saudi Arabia. No formal treaty, just an understanding. Oil gets priced in dollars, full stop. Every country on earth that needs energy must first acquire dollars to buy it. That permanent structural demand for dollars funds the US deficit, underwrites US military supremacy, and lets Washington sanction any country it wants by cutting them off the dollar rails. One handshake, 50 years of financial dominance. That system has been eroding for a decade though. 1973, Arab nations cut oil supply to punish America for backing Israel. Price quadrupled. Gas lines. Dollar was declared dead. Kissinger flew to Riyadh and turned the crisis into the architecture itself. Then came the year 2000. Saddam Hussein switched Iraqi oil sales to euros, called it sovereignty. 3 years later, the invasion happened. Oil was back to dollars within months. You can draw your own conclusions. Then, 2022, Western sanctions forced 5 million barrels a day of Russian crude off dollar rails overnight. Russia now settles 67% of its oil in yuan. India pays for Russian crude in dirhams. Saudi Arabia let that 1974 framework expire quietly in June 2024 without renewal. The plumbing of a non-dollar oil market wasn't being planned. It was being built. Then Iran blew the door off. When the US and Israel struck Iran on February 28, 2026, Iran didn't just close the strait militarily, it monetized it. Chinese tankers allowed through. Payment conditions yuan only. $2 million per voyage cleared through CIP. Chinese payment system. No SWIFT. No New York bag. No American oversight. Iran has exported 11.7 million barrels to China since the war began. All in yuan, settled through infrastructure. America cannot freeze, America cannot monitor, and America cannot shut down. The US naval blockade is the counter move. Cut off Iranian ports, starve the war machine of oil revenue, signal to every country in the global south that the cost of switching currency rails is regime change. Venezuela was doing the same thing, selling oil outside the dollar in yuan. Trump took out Venezuela and Iran within weeks of each other. This is not a coincidence, but the move came too late. The infrastructure is already built. Iran just handed China the opportunity to accelerate it.
Kissinger built the system to survive oil shocks. He didn't build it to survive the oil moving in someone else's currency. The dollar's most dangerous enemy isn't a weapon. It is a tall booth. It is a tall booth.
Okay, so if the dollar's dominance is gradually fading, what comes next? And here's where things actually get really interesting. There isn't one single replacement. There are 5 different models being actively built right now, and they'll probably all play a role. Option number 1, BRICS digital currency. The BRICS nations are developing what they call the unit, a proposed digital currency that would be 40% backed by gold and 60% backed by the basket of the BRICS currencies. Symbolic notes were distributed at the 2025 BRICS summit. This isn't a legal tender yet, but it shows the direction of travel. Option number 2, Project Ambridge. This is multi-central bank digital currency platform that connects the central bank of China, Saudi, UAE, Thailand, and Hong Kong. It's already operational. It allows these countries to settle cross-border oil and trade payments directly, completely bypassing SWIFT. This isn't coming, it's already live. Option number 3, a multipolar basket. This is actually the most likely outcome according to the most mainstream economists. The dollar remains the largest reserve currency, but shrinks from 57% to maybe 40%. The euro holds about 20%. The Chinese yuan grows from 6% to maybe 15%. Gold and gold-backed assets fill the rest. No single winner. A more balanced world. Option number 4, a gold-backed standard. Russia holds over 2,300 tons of gold and China holds almost the same. Some analysts believe within 10 years we could see a new gold-linked settlement standard for energy trade specifically. And option number 5, blockchain settlement. And this one is the most radical and potentially the most transformative, which brings me to our next section.
And before we talk about blockchain, just a quick reference here on how the M-Bridge model, the central bank digital currency platform, is being actively used by multiple countries. It is live.
Now here's something most people don't know. The world's largest investment firm, BlackRock, which manages over $13 trillion in assets, is placing an enormous bet that the entire global financial system is going to move on to blockchain technology. Larry Fink, BlackRock's CEO, wrote in his 2025 annual letter to shareholders that, and I'm paraphrasing here, tokenization has the potential to fundamentally transform financial markets. And he has said publicly that in his view, every stock and bond will eventually live on a shared digital ledger. This isn't a French crypto enthusiast talking. This is a person who runs the biggest pool of investment capital on the planet. So what is tokenization? In simple terms, it means taking real assets, a US government bond, a share of a stock, a piece of a real estate, and representing ownership of that asset as a digital token on a blockchain. Just like dollar bill is a representation of a value, a token is a digital representation of ownership.
Look at the example of the real estate tokenization. A property worth $1 million is legally structured and tokenized into 10,000 tokens, which the investor can buy, and then rental income and appreciation are distributed to token holders. It looks like potentially the future is going to be tokenized.
Now, why does this matter? Because if assets can be settled digitally on a blockchain, you don't need a reserve currency to act as a middleman for global trade. You can exchange value directly in any currency without needing to convert everything to dollars first. BlackRock has already launched a tokenized money market fund called BUIDL on the Ethereum blockchain. By 2025, it had grown to $2.9 billion. Tokenized US Treasury bonds grew 539% in 2025 alone, from under $1 billion to $5.5 billion. Stablecoins, digital dollars, grew 76% to $225 billion. The infrastructure of a new financial system is not coming. It is being built right now by the biggest names in the traditional finance. According to research from Animoca Brands, tokenizations could eventually reach the $400 trillion traditional financial market. Now that's 30 times the entire current global GDP.
And this tokenization is not happening overnight. A structure was put forward. As you can see, the stage 1. Fiat money is almost 97% tokenized. The stage 2, the government bonds getting tokenized, is happening right now. And as you can see in the stage 3 and the stage 4, equities, ETFs, and all the other assets will be covered.
Now I know a lot of you are going to be thinking about crypto at this point. And I want to address this directly because I think it's important to separate the genuinely useful from the noise. Bitcoin is the original, created in 2009 with maximum supply of 21 million coins. No central authority can ever print more. In a world where governments are printing trillions of dollars, that fixed supply is increasingly appealing. It's been called digital gold. In March 2025, even the US government under Trump executive order added Bitcoin to its strategic cryptocurrency reserve. The BlackRock Bitcoin ETF launch in early 2024 became one of the most successful ETF launches in history. Bitcoin crossed $100,000 in 2025, though it's since corrected to around $74,000 to $76,000 in April 2026. Volatile? 100%, yes, but institutionally validated in a way it wasn't 5 years ago. XRP Ripple was designed specifically for cross-border bank-to-bank payments, essentially as a SWIFT replacement. It can settle international transactions in 3 to 5 seconds rather than 2 to 5 business days at fractions of a cent. After a long legal battle with the SEC ended in 2025, XRP is now free to expand banking partnerships. Singapore's central bank has tested settlement on the XRP ledger. Japan's Rakuten, with 44 million customers, is integrating XRP as a payment method. Ethereum is a platform that most of the new financial structure is being built on. BlackRock's BUIDL fund runs on Ethereum, as we saw. Stablecoins worth $180 billion sit on Ethereum. If BlackRock's vision of tokenized finance comes true, Ethereum is likely to be a core part of the infrastructure. Gold-backed tokens like PAXG and XAUT are interesting because they combine the 5,000-year track record of a gold as a store of a value with the efficiency of a digital assets. Given central banks are buying gold at a 70-year record pace, the underlying asset is certainly in demand. And stable coins, dollar-backed digital assets like USDC and USDT, with a total market of $225 billion, are essentially the new digital dollar. They'll face competition from government CBDCs, but they are already doing what CBDCs are trying to do.
And now, which I have to say very, very clearly, that crypto markets are extremely volatile. The total crypto market cap fell from $4.3 trillion in October 2025 to $2.2 trillion by early 2026. That's a 49% drop. Anyone telling any of this is a sure thing is either lying or deluded. This is educational information only, not a financial advice.
Alright. This is the section most of you came for. So what can an ordinary person actually do? Let me give you 6 practical, sensible steps. And I want to be clear, this is about being informed and thoughtful. Not panicking, not going all in on crypto, and not selling your house.
Step number 1. Educate yourself and keep educating. The most valuable thing you can do is understand what's happening. Read, watch, listen. Some great starting points. Ray Dalio's book, Principles for Dealing with the Changing World Order. The Bitcoin Standard by Saifuddin Anmas. JP Morgan's research on de-dollarization. It's publicly available. Understanding the systems is the foundations for every other decision you make.
Step 2. Understand gold's historical role. Central banks, the most sophisticated institutional investors in the world, are buying gold at the fastest pace in 70 years. They know something. Gold has been a store of a value for 5,000 years. It's not going to make you rich overnight, but it has historically maintained purchasing power through currency transitions. Physical gold and silver as a savings layer, not speculation, is worth understanding. Gold-backed digital tokens may make this more accessible than ever.
Step number 3. Think about currency diversification. If all your savings are in one currency, especially if that currency is being deliberately debased, you carry concentration risk. That doesn't mean moving everything offshore. It means being aware that assets priced in Swiss francs, Singapore dollars, or other relatively stable currencies exist. Talk to a financial advisor about what's appropriate for your situation.
Step number 4. Learn basic blockchain literacy. You don't need to become a developer, but just as a banking literacy was essential in the 20th century, Blockchain literacy is becoming essential in the 21st. Understand what a digital wallet is. Understand what self-custody means. That's holding your own assets rather than relying on an exchange. Understand what a stablecoin is. This knowledge will serve you regardless of how the technology evolves.
Step number 5. Consider real assets. Throughout history, currency transitions have punished people holding paper money while rewarding people holding real things. Real estate, productive farmland, businesses producing real goods, commodities. These asset classes have historically maintained their purchasing power far better than cash savings during the periods of currency weaknesses and inflation.
Last but not the least, step number 6, be patient and avoid panic. This is maybe the most important step of all. This transition will take years, probably a decade or more. The dollar will not collapse tomorrow. It will not collapse next year. There will be volatility. There will be alarming headlines. There will be people trying to sell you things based on fear. The wisest response is gradual, diversified, patient preparation, not reactive, emotional decisions.
So let me bring it all together. The dollar is not dying tomorrow, but the direction is clear. The data is undeniable, and the transition is already underway. The petrodollar deal that created 50 years of dollar dominance has expired. US debt has crossed $39 trillion with no credible plan to reverse it. The world's central banks are buying gold at a 70-year record pace and reducing their dollar holdings. And a parallel financial architecture, BRICS payment systems, CBDC networks, blockchain infrastructure is already live and operating. At the same time, the world's biggest financial institutions, BlackRock, Goldman Sachs, JP Morgan, are building the next financial system on blockchain rails right now. And understanding these trends is not depressing, it's empowering, because the people who understand what's happening are the people who can prepare thoughtfully while everyone else waits to be surprised. So, educate yourself, diversify sensibly, learn about new financial tools, think long term, and don't let anyone sell you fear.
If this video helped you understand something that's been confusing or overwhelming, please give it a like. It genuinely helps more people find this content. And subscribe if you may be interested in more of this in the future. Thank you for watching.